Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Every time this metric that we're about to show you happens, the stock market loses money. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, so what are we about to show these guys?
Yeah, it's interesting. It's been a head scratcher to me, and it was amazing that we found this information. Is that, when I was doing M&A work for my corporate job, we always had to have hurdle rates we had to jump over. And, it's one thing if your hurdle rate's of 1%, you're trying to leverage over borrowing 1% versus now companies are borrowing at 8 and 10%.
Right.
For their money, why are equities still staying where they are? And the reason obviously is it's a little bit of a stickiness. And so we ran across a piece of data here that I think is really cool for our listeners. Our listeners and those who are watching, is that at some point people don't stay sticky. They finally get around. Inertia breaks, if you will. And we saw that's when the banks started to having problems with their depositors. Just like we always talk crypto, you get the screaming edge, then the bleeding edge, then the early adopters.
Yep.
Well, we're kind of at that point now where we're at the early adopter stage of people saying, oh, I get 4.5% for my money. Why am I risking it in a stock market that's extremely overvalued when we go into recession? Well, lo and behold, this is a thing, Phil. So once the Treasury 90-day gets over 4.5%, guess what happens?
The market dies.
The market dies. People say, I'm putting money into T-bills. I'm putting money into money market accounts. I'm tired of the volatility that comes with the market swinging up and down. I don't want to lose any more of my money. And so this is what's happening. And here's the chart showing it. Every single time, Phil, this thing gets up here, the market shows losses. And we're here again.
You know what's scary about that is that this goes back to the 1990s, right? And you're right. Every time we cross that 4.6% threshold, the market goes negative. But look how high we are here compared to it's like the other times the market kind of knew this was coming. This is almost like surprise. So the fall from grace here is unlike anything we've ever seen in the last 30 years in this market.
Yeah, I think, Phil, because we've been told the whole time the rates have been rising, is that Powell's going to have to punt. And so why go through all the effort of getting out of your stock positions, paying capital gain taxes, if he's going to just turn right around and lift the market right back up to where it was before? And I think belief is starting to come into people's minds that, hey, maybe this thing isn't going down anytime soon. And also, not a bad way of doing it. And look, I'm the same way, Phil. Starting in January, we've been actually in February. So February, March, and April, I put $25,000 out of my stock trading account, my long-term stock trading account, into T-bills 90-day. I intend to stay there until Powell blinks and starts rolling that thing over. And I'm not alone here. I think in February, I was kind of all by myself. And by the time April is, it's everybody's talking about doing it. And so I think that's when we're going to start seeing more and more people pull money out of the market saying, hey, you know what? I'm happy if I get 4.5% for the next 12 months if we're going into a recession. And then plus what we talked about yesterday with the oil shock that hit and oil prices going up higher, is that I think more and more people are going to opt to, let's enjoy summer and let's get out of this market. But it's not just this, Phil. look at the credit tightening on this thing, real rates. So if you look at that, real rates were falling. That means Goldilocks was coming. Okay, now real rates are shot straight up again, Phil. Okay, and this is why gold is getting a bid, and the energy names I was confident was going to come back higher, and it just puts pressure on the market. This is when you have positive real rates like that, this is a problem. And so the market's struggling with tightening credit. And then the last chart I want to put up there is that it's starting to bite. Now, apologize, is a bit of an eye chart, but at the bottom right there, negative $20 billion in net new credit creation. And if you notice, every time we've gone into a negative credit creation event is that we go into recession.
Yep.
So these are things called coincidences, Phil, right? How many coincidences become a trend, right? And that's where I just want to show people, these aren't things like, everybody sits and they evaluate the market by, what happened today. Smart investors and traders are thinking, what's going to be happening to the market in 90 and 60 days, 90 and 6 months from now? You want to be pulling your stuff out as the market climbs higher. You don't want to be the guy selling as the market's falling, because then you contribute, to that decline. You want to get out on your own terms. And this is just screaming at you that what the Fed is doing with the emergency money may look like liquidity, but it's a liquidity trap. The banks aren't lending anymore. That's a risk off. Real rates are rising, risk off. 4.6% short-term money, risk off. Oil prices climbing. Well, money out of your pocket because it's going now to the Middle East and to Russia. It's going to all the people that hate us, and so all these things are just like my klaxons are ringing around my house here, and so I think it's just a good macro thing for people to understand. I'll throw it back to you.
Yeah, I think the credit tightening is probably the number one warning bell here. And especially when it goes up into where you've had an environment where credit has been rising rather quickly. And from the COVID till the last year and a half, I don't think we've seen a rise as steep as what we've seen here as far as credit in the system. And now you look at that and you say, well, the market hasn't been able to even go up. So it's not even like, QE, happy times are here. Here's some cheap money. Like that money's been going elsewhere to shore up things. So it's curious to me that the market, we topped out at going into like over 4,600, right? And for in the last 2 years, all we've done is make lower highs and basically lower lows. And on net, probably sideways if you zoom out over the last year or so. So tells me that we've got, a lot of things that are going on that are not bullish, even though that's a tricky thing about bear markets is you have these extremely sharp rallies as we've seen in the last couple of weeks. And it gets everybody thinking all is well. But if you were to zoom out and look at typical bear markets, and I don't have that chart up here, but you'll see that what we've been experiencing since the first of the year is quite typical for some of the ugliest bear markets where you'll see bounces of 20, 30%. All the while you're failing to go higher in the market, meaning that the highs that you put in here aren't higher than the previous big swing highs of the market. And that's where the big difference is. So I think, again, it's just the internals aren't confirming what you might be feeling in the stock market, especially if your portfolio is going up. The Fed, love them or hate them, is giving you an out here because you can now exit out of the market at pretty decent levels. I mean, we're not down a lot from the all-time highs. And now you can go into cash and get guaranteed 4+% on your money by going into a money market account or something like that, or treasuries. So it's not actually a bad spot. And, I think you look at it as easy out here. And then you're in a very good position because you can be defensive because your portfolio is mostly in cash. You're making guaranteed income on it, and let the fragility in this market and the underlying technicals play out as things soften into the rest of the year. You'll be in good position to pick up the pieces going into, later in 2024. And especially going into 2025.
I totally agree, Phil.
All right. Well, thanks for listening, guys. Appreciate it. Please hit like and subscribe. Really helps us out. And we'll see you on the next video. Take care.
Trade Genius.